What does the big beautiful bill mean for bonus depreciation? Here's what this means on your next real estate deal. One of the biggest tax advantages in real estate was fading out, and now that the big beautiful bill has passed, it's going to change the commercial real estate investment landscape dramatically. By the end of this video, you're going to know how the big beautiful bill affects bonus depreciation. This is a very exciting bill and one that I've been looking forward to all year. It's finally been signed. So stick around to learn how it will help you boost your cash flow, reduce your tax liability, and overall compound your wealth in commercial real estate. Check out the big bill. All right, so why is the big beautiful bill so important? Well, let's take a quick refresher here. Bonus depreciation. What is bonus depreciation? Bonus depreciation gives you a phantom loss, so it allows you to deduct a large portion or even the full cost of eligible property in the first year of ownership on the property. So what does that mean? Well, you have components of a building. You have HVAC systems, roofs, you have paving, asphalt, building components in a storage facility like walls, doors. So typically this type of property is called 5, 7, and 15-year improvements. These improvements are able to be accelerated in a depreciation cost segregation study. Think HVAC systems, interior finishes, site work, appliances. This is a massive lever for real estate investors who want to accelerate losses up front, especially when you're using leverage. So if you're buying a property at $1 million and you can pull out $600,000 or $700,000 of components of that building or short-term depreciation items, then you can accelerate depreciation in a way where you can generate 1, 2, up to 3 times the amount that you invested in that property of equity in the first year bonus depreciation that flows to you as the investor. If you'd like more information on depreciation, I made another video. I put it in the comments. It tells you all about what depreciation is, what are the rules around it, and how you can maximize it to defer the tax and increase your investment returns in real estate. So what shifted with the big beautiful bill? So in 2017, the Jobs Act laid out a bonus depreciation schedule where in 2022, you could bonus 100%. But each year after that, it reduced by 20%. So in 2023, it was 80%, 24 was 60%, 25 was to be 40%. In 2026, it was to be 20%. And then in 2027, it was going to phase out with no bonus depreciation. Well, that now changed. With the big beautiful bill, you can bonus depreciate 100% of the depreciation in the first year. So as long as you bought a property after January 15th in 2025, and it's in service, meaning it's usable, it's not a development, then you can bonus depreciate it now in the 2025 tax year. So let's look at what happened with this legislation. The big beautiful bill passed July 3rd, and this restores 100% bonus depreciation for all qualified property in service after January 15th. So what this means is after you buy a property, you come up with the depreciation schedule. You're going to break out the different components of the building. The different areas that you can depreciate are real property improvements, personal property, and shorter life building components. Now, you can't depreciate land. And land can range anywhere from 10% up to 40% of the overall value of the property that you bought. You exclude the land and you depreciate only the improvements. Now remember, to maximize bonus depreciation, you need to get a cost segregation study. And there are specific individuals that are cost segregation study engineers. They will be going to the property and determining what the schedule of depreciation will be based on all those different components. In the comments below, I'll leave a link that gives you an option for a cost segregation study company. You want to be sure that they're conservative and that they can defend the schedule, because if you get audited by the IRS, that is going to be their job, is sharing this is why they decided what could go into bonus depreciation and what couldn't. So why does bonus depreciation matter? I'm going to give you a list of 4 key things that bonus depreciation helps you as an investor maximize your returns. Number 1, it offsets rental income, also known as passive income. Next, it can offset active income that you generate if you qualify for real estate professional status. I've done many videos on those. I'll share them in the comments below. Next, it reduces your taxable income in high earning years. So if you generated a lot of passive income, then you're going to need a lot of passive losses to offset paying tax in that calendar year. And for investors who are limited partners in syndications or funds, you're going to want to ask, how much depreciation do I get, or what is the allocation depreciation on the assets that you're buying. In my Patriot funds, in my firm at Patriot Holdings, we allocate all the depreciation losses to the limited partners. This helps them get a large ratio of depreciation compared to their investment, typically 1-to-1. So if you're investing $100,000, you would generate at least $100,000 in losses that year, which allow you to offset any other passive income that you have. Or if you're a real estate professional, you can even offset active income that you bring in from your normal duties working in the profession that you're in real estate. The thing to look at as an investor, regardless of if you're a real estate professional, is the tax savings each year on the cash flow that you receive start to add up and compound. If you have a large depreciation loss that you can use against passive income, typically with real estate, the cash flow that you generate, if it's 5% up to 10% each year after you own the property, you can carry forward the depreciation losses and you are deferring tax. In that calendar year, you're not paying tax on the cash flow that you're receiving. Many investors don't look at that comparison when you're getting income from, say, a bond, a treasury bill, or a stock dividend. That is taxed as earned income or interest income versus when you're taking in distributions or cash flow from real estate. It's passive income, which would be taxed at ordinary income tax rates, yet you're not paying the tax for quite a few years because you're utilizing depreciation to offset all that income that's coming in. Until you use all the depreciation, you don't have to start paying income tax or 37% plus state tax until you've utilized your depreciation losses. This allows you to generate 30 to 40% more returns year over year until you actually run out of depreciation. So things to remember with bonus depreciation, and when using it, investors forget the fact that it's not tax-free. You're not getting out of paying taxes. It's tax deferral. So when you do sell the property, then you are going to have a recapture event. And what does that mean? Well, all the depreciation that you took would then be taxed. And there's a few ways that it could be taxed. If you're bonusing it, then it's taxed as ordinary income tax rates. So if you're in the highest tax bracket, it's 37% plus. If you're not bonusing it, then it's 25% federally. Most people don't look at this fact, and it is a large tax bill. So remember that when you're planning an exit strategy or you're investing in a partnership or fund where they're going to be selling the assets, you want to prepare for that tax event. So how can you possibly avoid paying those taxes upon a sale? Well, you don't avoid them, but you can defer them again, and you can 1031 exchange into another property. That's going to allow you to take those proceeds and invest them into another commercial real estate asset and defer the tax. Now, remember, when you do that, you've utilized most of the depreciation, so you won't have a lot of additional depreciation after you 1031 exchange into the next property, but you were able to defer your capital gains and continue to compound your returns, which is a really important strategy in real estate investing and why it outperforms many other types of investments. And then the only way that you don't pay tax is if you die. So if the property owner dies, there is a step up in basis on the asset, meaning all the depreciation that was bonused out is wiped out. And now you have a new basis. Whatever the property's worth at the time of the death is now what the basis is. And then the heirs can sell the property and not pay that capital gains tax. So what's the action steps? Well, what do you do first? Invest in commercial real estate, of course. Second, you get a cost segregation study and bonus out as much depreciation as possible so you can generate large losses in the first year of ownership of the commercial real estate asset. Third, use those losses. So first, they offset passive income. So even if you're not a real estate professional, you can use those losses to offset all your distributions or cash flows from real estate. And then secondly, they can carry forward and you can use them in future years as you get more passive income or as you sell off other real estate properties that generate capital gains. Next, look at being a real estate professional or your spouse being a real estate professional. It doesn't mean that you need a real estate license. Check out the video in the link below, and that will tell you how to become a professional. But the key strategy there is you would be able to then offset active income or earned income from a job or business or profession, and those real estate depreciation losses can then wipe out or offset all your taxable income in the calendar year that you earn them. Next, you want to prepare for exits. So if you're able to bonus out a lot of depreciation, then you may want to sell other assets that are going to have a large capital gain, and you can use your losses from the new acquisition and the bonus depreciation to offset that large capital gain. Next, when looking at passive investments, talk to the syndicator or the investment fund manager and ask them, how is the depreciation treated? If you get the majority of the depreciation or all of it, that's a bonus if you're looking to be a limited partner or investor in real estate. And lastly, partner with a great CPA. Timing matters. Timing is everything when it comes to tax. So having a plan up front, understanding how to maximize depreciation losses, and then when to buy and when to sell real estate is critical. And having a professional guide you or advise you is necessary to be an outstanding real estate investor. In the comments below, I will put some of my preferred professional CPAs that just focus on real estate investors' taxes. So now you know everything about the big, beautiful bill. In the next video, check out how to execute on 1031 exchange. I give you the nuances, the rules, the strategy around using 1031 exchanges. So after you bonus out all the depreciation, you can continue to defer tax and compound your returns.